Verizon Communications, stock ticker VZ, is a stock that pays out big dividends. If we come down here, we can see the current dividend yield is sitting a little over 6.3%. Now, if we look at how this company has performed over the past year, it's up around 10.4%. Year to date, up around 11.3%. But if we look at longer time horizons, this is where things start to not look quite as good. Over the past 5 years, down around 29%, and over the past 10 years, down 13%. Now, we need to be fair. The company provides most of its returns in the form of dividends. So we don't need to just look at price return, we need to also look at total return. But unfortunately, the picture doesn't get much better when we do that. If we look at the total return for Verizon over the past 10 years, they are up around 41.61%. That's pretty bad compared to the S&P 500's 235% during that same time period. And over the past 5 years, even including dividends, they're down around 8%. So in this video, we're going to be taking a deep dive into the company, looking at some of their financial metrics, looking at some recent news, and of course, calculating the intrinsic value to see if this is a stock we should consider buying at its current prices. And like always, if you'd like to be able to download any of my spreadsheets and get access to the ticker data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description. So let's go ahead and start jumping into it. Now, the first thing that I want to do is I want to go ahead and start looking at the dividend metrics for Verizon. Obviously, people interested in this company are interested in it because of the dividend. So if we jump over to my dividend breakdown spreadsheet and plug in VZ and hit enter, we can see all that data will automatically load in thanks to the help of the ticker data function. But again, massive starting dividend yield of around 6.34%. And if we come down here and look at those yearly dividends, we can see they have a good track record of increasing those dividend payments every single year, going from around $2.08 in 2013 to $2.62 in 2023. And for 2024, they're projecting around $2.66. So when we look at these dividend growth rates over a 5 and 10 year time period, again, 5-year dividend growth rate of around 1.89% and a 10-year dividend growth rate of around 2.2%. So the dividend payments are growing, but here's the big problem. If we look at inflation over the past 10 or so years, you can see from 2014 to 2020, we saw relatively low inflation rates. For the most part, it was around 2.3% or lower. But look at the past few years, 2021, 7%, 2022, 6.5%, 2023, 3.4%, and 2024 so far is projected to be maybe around 3.2%. So here's the big problem with that. If a company is increasing their dividend payments at a rate below inflation, then that company is technically paying out less in dividends every single year. So yes, while they are increasing their dividend payments, it doesn't beat the rate of inflation. To me, that's a pretty big red flag for a dividend growth company. I need companies, in order to be able to live off dividends, that are increasing dividends at a rate above inflation. So I'm not happy to see those dividend growth rates. Now, here's the reason they can't increase dividends at a higher rate. Look at their free cash flow growth over the past 5 and 10 years. It's been pretty stagnant, and if we look at the free cash flow versus dividends paid out chart here, we can see free cash flow is absolutely all over the place. Again, free cash flow is the blue chart here. It jumps around quite a bit. Ideally, I'd like to see solid and steady growing free cash flow year over year. Now, the dividend payments have been growing steadily year over year, but again, we can see if we look at the free cash flow payout ratio over time, around 59% of the company's free cash flow was used to pay out dividends in 2023, and in 2022, it was even higher. It was over 103% of the company's free cash flow. So ideally, we want to see their free cash flow payout ratio stay close to the range it was in at 2023, but obviously, as unpredictable as the free cash flow has been over the past few years, it's hard to say what it'll look like moving forward. Now, if we jump over to a new spreadsheet I've recently built out and plug in Verizon and hit enter, and again, we can see this data will automatically load in. Now, the first thing that jumps out to me is look at this revenue per share. It's been pretty stagnant for over a decade now. We've seen essentially no growth in revenue per share. Not a good sign. Look at the earnings per share. It's kind of jumped all over the place, just like free cash flow per share. And overall, we want to see solid and steady growing earnings per share, and that's just not the case for Verizon. If we look at shares outstanding, we can see it has slightly increased since 2014, so maybe you've been slightly diluted if you're a shareholder, but it's nothing really too crazy. So yes, top and bottom lines really haven't been growing much for Verizon over the past decade, but there is one potential catalyst for them moving forward. Obviously, historically speaking, people buy Verizon because of the dividend payments, but lately interest rates have been so high, it doesn't make Verizon as attractive of an option. And so we have to keep in mind there's likely some correlation between interest rates and Verizon stock. We can see Verizon shares plunged when interest rates jumped up and have since started to rebound. And that was just around the same time that the Fed said it was probably done raising interest rates. So that is one potential catalyst for Verizon. Now, I think you could argue this has already been priced into the stock, with them being up 10.4% over the past year and up around 11.3% year to date. Now, if we keep moving forward in our analysis of this company, let's go ahead and take a look at the profitability. I'll come up here and plug in VZ and hit enter. And there is one key concern I have of Verizon when looking at this profitability spreadsheet. Look here at our 10-year average gross profit ratio, sitting at about 56.91% for Verizon, but look at their gross profit ratio in the most recent year, 45.88%. So the company is seeing slowing revenue growth, but the gross profit margins are also declining. That is not a good sign for this company. If we look at this charted out historically, we can see for the most part their gross profit ratio has stayed in the range of around 60%, but over the last couple of years, we have seen that decline. And this basically means less and less money is going to the bottom line for this company. So with all this being said about Verizon, is it worth considering buying at $41.96? Is it worth getting that juicy 6.34% dividend yield, and is it trading at a good value? And to answer that question, let's go ahead and jump into my valuation spreadsheet. You can see I've already plugged in Verizon stock right here. Now, one thing we do need to point out is the beta for this company sitting at just 0.38. You should see very, very little volatility with this company. So maybe if you're someone looking for immediate and predictable dividend income and low levels of volatility, Verizon does fall into that category, so it may be something you want to consider. Now, the first valuation we're going to go ahead and look at is going to be Graham's valuation. And this basically values a company based on the projected earnings per share growth. Now, we can see right here with the help of the ticker data function, we can bring in the estimated earnings per share average for 2024, and it came in at around 4.54. And if we look at Verizon's expectations in their 2024 guidance, we can see that is in the range that they gave us for their 2024 guidance. So if we jump back over to our spreadsheet, we'll go with 4.54 for the earnings per share projection in 2024. We then apply these other projections such as growth rate at around 3, multiply by 4.4, which is the average yield of AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds at 4.78. And when we plug all that in, we come to an intrinsic value of $41.79. Now, the next valuation we're going to look at is going to be our discounted cash flow analysis. And basically, we're valuing the company based on how much free cash flow they're going to produce in the future. So I'm projecting a 3% free cash flow growth rate to the future free cash flows of the company. We then find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, subtract out the total debt to get the equity value. Once we do that, we divide by shares outstanding and we come to a DCF price per share of about $40.77. Now, typically the next valuation I like to look at is the multiples valuation, but really in the case of Verizon, I think the only fair comparable is AT&T, and you really don't want to run this valuation if you only have one comparable, so we're not going to use it in this scenario. We're going to jump to our last valuation, which is the dividend discount model. Now, this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. And just like we saw earlier, historically speaking, over the last decade or so, their dividend growth rates annually have been around 2%. So we're going to stay with that growth rate, apply a 2% dividend growth rate, discount rate of 8%, and we come to a dividend discount model price per share of $45.22, a little bit above that current trading price. So when we jump over to the output tab, we can see our three valuations: Graham's at $41.79, DCF at $40.77, and dividend discount model at around $45.22. And when we average all three of those together, we come to an intrinsic value of $42.59, slightly above that current trading price by around 1.5%. So with a 10% margin of safety, you could see our acceptable buy price sitting at about $38.33, and with a 20% margin of safety, acceptable buy price of around $34.07. Now, if we jump back over to Seeking Alpha and look at the past year, we can see there have been times when the company has traded within that range. In fact, its 52-week low was sitting at about $30.14. So again, you do have to be ready for those opportunities when they present themselves. Now, as for me, I don't think Verizon has a place in my personal portfolio. The goal for my portfolio is to one day be able to live off dividends, and while they do pay out big dividend payments, those dividend growth rates like we saw earlier are just too low for me being able to justify holding it in my personal portfolio. I need dividend growth rates that beat inflation by a large amount in order to live off dividends as fast as possible. Now, if you're someone looking for immediate and predictable dividend income, maybe Verizon could be a good option for you, especially because like we saw earlier, that beta is sitting at just 0.38, so you'll see very little volatility with this company. So as to whether or not you should consider this company really depends on your goals. Based on the valuations we looked at, it does look like it's trading pretty close to fair value, and with interest rates potentially dropping, perhaps that could be a catalyst for the company. But go ahead and let me know what you think of Verizon in the comments down below if you plan on buying or selling, and like always, if you'd like to be able to download any of my automated spreadsheets and also get access to the ticker data function, which allows you to automatically pull in stock financials into Google Sheets, then you can head over to tickerdata.com at the link in the description. So with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.